Happy Friday, everybody. Mike Sorrentino here, and much to discuss. We got the first quarter in the books, finally, and it was a good quarter. In fact, one of the better quarters we've seen to start a year in a very long time. I'm going to start with hopefully a very optimistic quote for those out there. I know we've seen a little bit of volatility this week, and that's fine. We'll talk a little bit about that, but I'm actually kind of glad that we've seen some come back. Great quote on the market from Ryan Detrick, who's an analyst or more along the lines of a strategist at Carson Group. When the S&P 500 gains more than 8% for the first quarter, it has finished higher for the rest of the year 94% of the time, with an average gain of 9.7% for the final three quarters. That's awesome. Now, we know that calendars and history do not predict future returns. We know that, okay? But history often rhymes for a reason. At 94%, I feel like it's something we might want to pay attention to. All right, so that's good to hear. And let's hope that Mr. Detrick is correct in his assessment. All right, the bull market, let's talk about it. It's on. It is on big. Rewind the clock 1 year ago. 1 year ago, the conference board had predicted a 99% probability in March of 2023, a 99% probability of a recession by August. And in fact, that's what those blue bars represent. A year ago, there weren't that many bulls out there, all right? A year ago, there were way more bears than bulls. That doesn't happen very often. Why? Because markets tend to go up over time. Stock market tends to go up over time. So it's okay to be bearish at times. There's nothing wrong with that per se. But for the most part, you tend to want to be more bullish than bearish because of the natural progression of markets going up. Now, fast forward to today, or almost today, mid-March of this year, a couple weeks ago, those red bars are pretty interesting. Oh, how the tide has turned. The bulls are back, and they're back big. They've been back for a while, but now there's a dramatic resurgence of optimism going into the markets. And I think we've seen a little bit of that. We're seeing stocks at all-time highs. That's good. We're seeing Bitcoin back in a big way. Kind of speculative, but fine, whatever. But I do think that we're seeing a significant shift in optimism. Now, just how good was the first quarter of the year? And we can see it here. If you take the best performance for the first 61 trading days, it's from Mr. Charlie Bilello at Creative Planning. He shows us that this year at the bottom was the 14th best year going back to 1928, 6 years-ish. Almost a century. Number 14, not so bad, okay? Up over 10% through the first 61 trading days. Okay, so we have a situation now where markets have been going up comfortably over the past couple months. But we all know, all right, if you've been listening to my webinars, read my writing, you know that this can't last. All right, I'm not trying to be a Debbie Downer or a Cassandra here, okay? I'm just being honest. And I'm looking at the data. The VIX, V-I-X, the VIX index is a measure of volatility. Now, it's not a perfect measure. There is no perfect measure out there. What this basically does is this is checking to see what type of negative bets are being placed on the market through a specific type of stock option play. Doesn't matter how it's calculated. Point is, this is what we call a mean reverting index. Mean reverting index. What that basically implies is that when the VIX is above its long-term average, it tends to come down to that average. And when it's below the average, it tends to come up to that average. So what that means is when the VIX, or when the volatility in the market is really, really low, it means at some point it's probably going to come back up. That's what a mean reverting index is. The average for the VIX going back, 20 years or so, is just over 19. Well, we're closer to 13 right now. All right, this was done a couple days ago, maybe about a week ago. So that's probably a little bit higher after we've seen a few days this week, but not much higher. So my point here is that at some point, something is going to happen. All right, I'm very sure about that. Why? Because it always does. Something always happens to spook the market, or people take profits, or whatever it might be. Something happens. A Fed governor, like this week, Neil Kashkari, Minneapolis Fed, who's not even a voting member of the Fed this year, said that rates might stay where they are for longer. Basically implied that. And people freaked out. Okay? This stuff happens. It's unpredictable. It's going to happen again. But that does not change our investment strategy. All right? When these little volatility spikes happen for reasons that are kind of silly, we try to, as best as possible, ignore them. Because when I look at the fundamentals, I don't see any major degradation in the fundamentals. Remember, the U.S. economy, we've talked about this a lot, the U.S. economy is the greatest growth engine that we've ever seen in the history of mankind. This economy we live in wants to grow. It needs to grow. It is designed for growth. And when it does not grow, when it's shrinking, it only does that for a small period of time. And if you think about the returns of this index, the S&P 500, start on the far left-hand side in 1970. If you invested $10,000 in 1970, by the end of last year, you'd be worth $2.3 or $2.4 million. That's an average annual return of 10.7%. Wow. That is awesome. There's no measure of inflation on the planet, at least in our country. Maybe I should say our country, rather. That's a bad way of saying it. There's no measure of inflation in our country over this time period that has been higher than 10.7%. Not even healthcare, not even education. So if you want to generate real wealth over time, the U.S. economy has been a great place to invest in. And you got to think about what we dealt with along the way. All these terrible things that have happened in our country. Dot-com crisis, all right? What else has happened? The financial crisis. All right, all these awful things that have happened along the way. Boston won a World Series, all right? We're still here. We're still moving along. And I think we're going to do fine going forward. But we don't want to let a little volatility spike along the way spook us out of what's happening. I mentioned earlier, the U.S. economy is a growth engine. It needs fuel. And right now, we are sitting on an innovation tsunami of fuel about to hit our economy. We talk a lot about these themes on and off periodically. AI, okay, that's out there. Everybody's all excited about that. That's fine. But I'm talking about other things, like how the video game industry right now, video games, it's bigger than movies and music combined and growing at a growth rate way faster than the other two. I'm talking about how people treat their pets like kids. I'm talking about how solar energy now is cheaper than natural gas in terms of production. I'm talking about infrastructure that could potentially change the world in the next 10 years. We're talking about onshoring, okay? All those CEOs over decades that pushed all their manufacturing outside the US for cost advantages. Then you realize during lockdowns a couple of years ago how brittle that supply chain really is. And they're starting to bring that back to the United States. That's a 10 to 20-year trend, and we are in the very early portion of the first inning. Exciting stuff like that. We're talking about healthcare. We're talking about NK cells there, natural killer cells taken out of your body, retrained, reprogrammed, put back in your body, and taking care of diseases. Your natural body, your immune system, no drugs. No side effects for the most part. That's the kind of stuff that's going on right now. There's a great quote about technology. I think I've used it in the past. Technology has never moved this fast before, and it's never going to move this slow again. These are the trends we want to invest in. We don't want to let a little bit of potential volatility, if it even shows up at some point, we don't want to let that derail us from what really matters for our investment returns over the long run. There's so much to look at right now. And the best part, as we always talk about, is that it's here in the United States. You have a home court advantage. So I'll finish up by saying one other thing. I wrote this week about the difference between assets and investments. The idea that a lot of times we'll hear things like, well, buying a house is a great investment. Buying gold is a great investment. Bitcoin is a great investment. And when I hear these words, I tend to cringe a little bit. Not because I don't think you should own them, not because I think it's better to rent than versus to buy. I mean, there are times when it makes more sense, don't get me wrong, but buying a house isn't necessarily a waste of money. It's just not an investment. There's a difference between an asset and an investment. An asset is a store of value. It doesn't do anything, it just sits there. And then over time, the supply of that asset and the demand to own that asset determines its price. Gold is a great example. Gold does not produce cash flow. It does not generate earnings. It does not pay dividends. It just sits there. And it is perfectly fine to own. But don't confuse the idea of an asset to an investment, because that is when you can get yourself into some serious trouble. Like I said, because gold doesn't generate cash flow, because gold just sits there, it is incapable of generating income in your retirement. A house is not an investment. Your primary residence is not an investment. Unless you are renting out property or real estate and it is generating a cash flow, it is not an investment. Stocks, bonds, these are investments because they produce something. Now, I try to be very clear. There is absolutely nothing wrong with owning investments. We all own them. I'm sorry, assets. Excuse me, asset. A car is an asset. It might be a depreciating asset, but it is an asset. We have to own assets. Investments generate stuff. And the best example I could show you is on the screen here. The purple line is the Wilshire 5000. It's basically an index of the total stock market over time, going back from, I want to say, about 1980. Compare that to that orange line, which is gold. So gold, since 1980, is up about 857%. The Wilshire, and look at the difference here. The stock market is up 17,000%. It's not even close. 25 times or whatever the number it is, the return. All right. And again, I'm not ripping on gold. Gold is a perfectly fine thing to own. But this is the reason why investments should never be confused with assets. Investments produce something over time. So when you think about portfolios, when you think about wealth management, when we think about a strong, solid financial plan, there is a place for both of these in that financial plan. Just don't confuse one with the other, or else you could put some risk into your plan that you may not have intended to see. So with that, I hope everybody has a great weekend. Congratulations on the first quarter, and let's hope the streak continues.